Today, New Zealand's Reserve Bank says its monetary policy as usual. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian and indeed New Zealand flavour. Governor Adrian Orr and his team appeared before New Zealand's Parliament's Finance and Expenditure Select Committee today in Wellington to discuss its latest Financial Stability Report. So today I'm going to look briefly at the report, but also at his remarks. The central bank last month raised the official cash rate by half a percentage point to 1.5% and signalled further hikes to come. The Reserve Bank of New Zealand is raising rates rapidly because the environment has changed, Orr said. The rise in New Zealand interest rates has been very large relative to movements in other countries and one of the steepest rises in the past 2 decades, albeit from a low level. By acting to anchor longer-term inflation expectations, this increase in interest rates helps to reduce the need to further tighten monetary policy in the future, they said. Maintaining low and stable inflation and avoiding unnecessary volatility in financial conditions is preferable for financial stability. Now, in New Zealand, house prices have declined since November last year, and the borrowing capacity of potential buyers has been reduced due to tighter loan-to-value ratio requirements, higher mortgage rates, and changes to responsible lending processes under the Credit Contracts and Consumer Finance Act of 2003. Previous supply imbalances are declining, they say, as well, given high levels of residential construction activity and muted population growth. Along with rising interest rates and tax policy changes affecting investors, this continues to point to current prices being unsustainable. Debt servicing costs will increase significantly as current fixed-rate mortgage reprice over the coming years. Some recent mortgage borrowers are vulnerable, they say, and could face difficulty servicing their debts, but overall the threat to the financial system is limited. Banks kept test interest rates at their serviceability assessments around 6% during the pandemic, which remains above current mortgage rates, and this provides some reassurance that buffers are in place to ensure debt serviceability continues. Lending to households has slowed from its peak in the middle of 2021, and this partially reflects lower household demand for credit as housing market activity slows on the back of rising interest rates. And business sector borrowing has recovered after contracting sharply in the early stages of the pandemic. And banks have reported that this mainly reflects borrowing for working capital, property acquisition, and expansion of premises. Borrowing for other capital expenditures, though, remains subdued. And lending to the agricultural sector continues to decline as the dairy sector continues to deleverage. Overall, they say non-performing loans and arrears remain at low levels. The share of housing loans on hardship programs remains low relative to its peak during 2020. And in the hospitality and retail trade sector, the share of non-performing loans and arrears is little changed since the middle of last year. Now, Orr was asked if the Reserve Bank was too slow to respond to inflation risks.
This time last year, I asked you a question about inflation because rates were just starting to tick up in America. Let's say your comment back then a year ago was pretty dismissive. You continue to run a no regrets policy. You've still got the funding for lending program. Do you think in hindsight, looking back now, that you're a bit slow to react to the inflation risk? Do you have regrets now around the approach you've taken with the OCR?
The regret question, that's great to have. No, I have no regrets and I will continue to have no regrets. Why? Because you have to play the cards that are in front of you at the time. And the important thing that people have to remember is the level of transparency of the Reserve Bank is at the global forefront. You can go back and look at our record of the meetings, our projections, the data we used and the decisions we made. It's all there. So regret analysis, I don't, why would I buy into that? I regret not buying Apple shares in 2001 or something. The answer is regret no. Let's step back and just kind of breathe and think about what we've gone through. Our core inflation measures right now, the measures that we can most influence, ignoring the 1/3 of the food and energy prices that add to inflation, the 1/3 around the construction costs, etc. These things there. Our underlying core inflation measures are somewhere between 3% and 4% per annum. Our target range is between 1% and 3%. Given the nature and scale of the economic shocks we come through, I am positively surprised how well we have come through this activity. Headline CPI is 6.9%. I see that, I understand that. We cannot do anything about global oil prices. We just have to understand that they have added to headline CPI. They will be an impact on real incomes. They will impact demand on the way through, and that will impact on whether, by how much or what we need to do different with interest rates. Meanwhile, we were one of the first countries in the world to stop quantitative easing and to start raising our interest rates. As much as we like to think we are a big, important country, going alone on monetary policy in the nature of a global shock takes enormous courage. And I congratulate my Monetary Policy Committee members and our staff for doing that. If we get out of step, we have significant risk to interest rate output and exchange rate stability. And member, you have been very vocal around exchange rates, interest rates in the past when you get out of key. There's no free lunch here. So no regret, very courageous, very proud of where we are. Yes, we have issues. There is no upside to high inflation. So our job is to dampen it.
Okay, so you're saying no regrets, but you've now done a rapid number of increases and you're projecting a whole step. Everyone expecting you to put up
because the environment has changed.
So you're now in a situation where you're having to do rapid increases now. CR, as you already acknowledged today, it's 2 years before anyone it will feed through into the economy, right? So I suppose the wider issue is the timing around that and the severity of what you're having to do to try and play catch up. How do you respond to that?
Well, I respond to it by saying we're not playing catch up. We're just doing monetary policy as usual. Two, being aggressive or rate of change of interest rates. Interest rates at 1.5%. Neutral is at 2%. This is not. This is. Please don't get high debt levels and confused with where neutral interest rates are. That seems to be the conflation. We've got this. It's business as usual.
Yeah, I guess just listening to your last answer, you've talked about the oil shocks, you've talked about supply chains, and you've talked about COVID and all of that. And I just want to get a sense of how much of this is domestic and how much of this is influenced by what's happening globally. Because if I do the maths that you've just said, it's more than it's 2/3 or more. So can you just talk us through that?
You do. I mean,
so headline inflation now is 6.9%. Around 1/3 of that is food and petrol, which has a significant global contribution to that. Around 1/3 of it is housing related costs. So construction costs, for example, Adrian referred to, also things like rents, and local authority rates. And then the last third is kind of other components, which is more broad-based inflation, which is also rising as well. So it gives you a little bit of a feel for the breakdown there.
But when you go into those, you talked about construction costs, you've got supply chains as well as housing. So how do you disaggregate that?
Well, we can only say what is the index now, because the difference between a snapshot of what's been measured now and what Chris has done there is said the contributions are about a third, energy, food, international, construction costs through and local authority costs there, and then the other third. So that's now what do we need to do? We need to think around, well, what with our instruments, where is the core underlying domestic driven inflation component? And what I was saying is that is too high for us, but that is significantly below the 6.9. It is around the 3 to 4% range. So that's where, the 18 months, 2 year question I was asked earlier, that is the part that we need to be leaning against. We cannot lean against global international oil prices.
Okay, I'm just going back. So the risk that we have, and I think you've flagged it, is around stagflation, where we have high inflation, high employment. Is that a real concern to you? And if it is, how are you going to manage that with a dual mandate?
Yeah, so it is a concern to us, which is why we are acting, but we don't see stagflation as the core risk. Why do I say that? Because the inflation part of these stagnation plus inflation, the plus inflation part, we now have central banks focused on achieving low and stable inflation, and central banks globally are acting to do that. When we had the stagflation that we grew up amongst in the 70s, etc., we didn't have central banks focused on these tools. We didn't have operational independence. It was just a completely different world. We had fixed and pegged exchange rates. So it is chalk and cheese, but that doesn't mean that I shouldn't be worried. We need to be worried because we need to make sure that the inflation component is taken out. What happens on the real economic growth side, well, that's a whole other story.
We're not playing catch-up. We're just doing monetary policy as usual, he said. We've got this. But it was another testy exchange with opposition politicians on the committee who pressed Orr over surges in house prices during the pandemic and now the fastest inflation in more than 30 years. They actually suggested that the Reserve Bank overstimulated the economy with record low interest rates and was too slow to start tightening policy. Of course, remember, it began raising rates in October last year. So it is interesting to hear Orr defending his strategy and, frankly, taking no prisoners in the process. And he did, quite rightly, start lifting rates earlier than many other central banks around the world. Kudos for that, I think. But getting inflation under control will be a problem, not least because some of the inflationary pressures are homemade, thanks to the quantitative easing programs and very low interest rates, but some of it is also delivered by the supply chain disruptions too, which are continuing. And it may well be that the supply chain issues continue for some long time. So expect rates to rise quite significantly higher, although precisely how high, of course, is the big question, and the bank will continue to be data dependent. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.